Ready for another exciting Bitcoin update? You guys know Gareth Soloway with his expertise and track record that make him a trusted source for traders and investors who are seeking valuable trading tips and strategies. Here's Gareth's update on the latest news about Bitcoin's market status. Gareth Soloway mentioned that there's a trend line that was previously discussed at the 30,500 level. The price briefly crossed it a couple of times but quickly retraced. Currently, the market seems to be in a state of low volatility. Since mid-March, the price has been trading sideways within the range of 27 to 30,000. From Gareth's perspective, this level still resembles a bear market rally. However, if the price manages to surpass the 30,500 level, it could potentially indicate that the low point was around 15.7. He states that he doesn't currently see that happening, and notes the presence of speculation in various markets, including commodities, cryptocurrencies, and stocks. He believes that bottoms are typically formed when there is a high level of fear and skepticism, but the current market behavior, particularly with Bitcoin and meme coins, reflects a speculative environment rather than a bottoming process. Gareth also mentions government regulation and its potential impact on cryptocurrencies. He suggests that the government is delaying regulation until the launch of a central bank digital currency, which could affect the value and usefulness of stablecoins like Tether and USDC. Regarding the stock market, he points to high valuations and speculation, highlighting Apple's trading at a 28 forward price to earnings ratio as an example. He believes that speculation needs to decrease, and as a result, the stock market will come down, affecting the crypto market as well.
Yeah, so a couple different things, right? And you're right, here's the chart. We have that trend line that I had in last time we discussed it, right at that 30,500 level. We pierced it briefly a couple times and then came right back in. And we've really gone into this sleeper mode. If you go back to, mid-March, we're still sideways in this 27 to 30,000 range. So to me, this is a level that is still reminiscent of a bear market rally. If we get above, like I said last time, above that 30,500 level, we can start to talk about maybe the low was 15.7. But as of now, I don't see that. And I still see speculation. I mean, in trading markets, including commodities and cryptocurrencies and stocks and everything else, bottoms are made when there's massive amounts of fear, and people are very skeptical initially when something takes off. With Bitcoin, it hasn't been like that. We've seen the speculation in Pepe coin and all these other meme coins. It's a casino, and that's not the sign of a bottom. In addition, I look at what's going on with the government regulation. The government's purposely holding back regulation until they launch their CBDC, which then brings into the question of, is Tether even worthwhile anymore? Is USDC, is that even worthwhile if you have a CBDC that's basically fulfilling that job? Does that have an impact on the cryptocurrencies as well? And then you go to the stock market. And again, I go back to the speculation, the valuations. Apple's trading at a 28 forward PE. That's ludicrous. We have to see speculation come down. I think the stock market comes down, and therefore it brings crypto down too.
Gareth Soloway also expressed a bearish outlook for the second half of the year, predicting a potential correction of up to 20% in the S&P 500. Gareth then can be seen analyzing the charts to support his viewpoint, emphasizing that after the market euphoria in 2021, a drop occurred followed by a period of complacency and sideways consolidation. Gareth compares the current market pattern to the dot-com bubble in 2000, highlighting similar chart formations before significant downward moves. He particularly focuses on the Nasdaq, stating that it might take 10 to 15 years for the index to reach new highs after the dot-com bubble burst. He then suggests that the current market conditions, influenced by the Federal Reserve's money printing, may result in a similar scenario, where the Nasdaq fails to meet new highs for at least 10 years. Yikes. He concludes that the mirror images on the charts are concerning and indicate the potential beginning of a bear market, which you'll see now.
I actually have a very bearish outlook for the second half of this year. I'm actually looking at a correction of as much as 20% in the S&P 500. The charts are telling us this too. I mean, if we just look purely at the S&P 500, in fact, let's go right to that chart right now. What we see is a chart that had a big drop following the 2021 highs in in January of 2022. We saw the big drop. We've then seen complacency take hold. And this is really important for investors to understand. This is the way tops are made. You have this euphoria, which we saw in 2021 in all markets, including stocks and cryptocurrencies. You then have a dip, and then you have sideways consolidation. In fact, let me see if you would just let me bring up this chart of the NASDAQ composite. I want to show you this because I think this is a game-changing chart. And I'm going to put two side by side here. So here on one side, let me bring up the NASDAQ as well. We're going to look at the NASDAQ in two charts. All right, we're going to bring up the weekly chart here and the weekly chart here as well. And what I want to do on this weekly chart, going all the way back, we're going to go all the way back to the 2000 market when the dot-com bubble hit. Okay, now what we see here, look at this. This is just, by the way, Danielle, this is the stuff I live for, right? So what we saw was the down move off of the euphoria, right? We all agree that the dot-com bubble was euphoria. We then had the down move, and then look at the pattern that happened before the bigger move down occurred. And then if we go here, we look at the same sort of pattern formation, right? And so my thesis is that this is just the beginning of a bear market that we are entering in. And if we look at what the NASDAQ did, we know, first of all, the NASDAQ didn't make highs for 10 to 15 years. In fact, I think it was even 16 years. I actually think we're in the same position here where we've had so much bloat due to Federal Reserve printing of money that when this starts to drop, we're going to see the NASDAQ not make highs for probably at least 10 years going forward. But again, the mirror images on the charts are scary here in terms of the 2000 period and what we're currently seeing.
Next, we can see Gareth Soloway. We'll be discussing the current state of the market and the factors that have contributed to the prolonged bull market since 2009. He attributes this market growth to the Federal Reserve's policies of printing money and maintaining low interest rates. According to Gareth, the government has been injecting money into the economy, essentially providing free money through stimulus checks and other measures. Gareth then addresses the issue of inflation, while acknowledging that the Consumer Price Index data has shown some increase, believing that inflation will not reach that target rate of 2% due to various underlying problems. The initial drop from 9.5% to the current rate of 4.9% is seen at the easier part, attributed to supply chain disruptions. However, the increase in wages has become a sticky issue, making it difficult to reverse the inflationary trend. He also stated that inflation is likely to remain around 3% for several years, which will restrict the Federal Reserve's ability to stimulate the economy by printing more money or lowering interest rates. Gareth argues that if the Federal Reserve were to continue these actions with inflation at 3% or 3.5%, there could be a sudden spike in inflation of 15% or higher. This cautious approach by the Federal Reserve, in his view, limits their ability to rescue the market during times of crisis.
No, that's basically the thesis of it, is that if you look at, first of all, the cycles, you have a cycle here where we're due for a corrective move. It's been an elongated bull market. If you go back to 2009, it's all due to Federal Reserve printing of money and low interest rate policy, essentially they were just dropping money left and right, free money and printing money. The government was sending out checks. And then you look at what's happening now. Yes, inflation, we saw the CPI data come in a little bit, but it's not going to get back to 2%. It's just, there's too many issues. The first drop from 9.5% to where we are now at 4.9, that's the easy amount. That's the easy drop. That was supply chain. The problem is wages have gone up and it becomes very sticky. Once those wages go up, it's very hard to get that genie back in the bottle. So you're looking at inflation that probably stays at 3% for multiple years, and that essentially handcuffs the Federal Reserve. The Federal Reserve is going to be very, very careful and wary of printing money or lowering interest rates with inflation, let's say at 3 or 3.5%, because they're going to worry it's going to be a big pop to 15% as the next result. So without printing of money, this market has not been a real market for a long period of time. And when the investing public realizes that the Fed's not going to come to the rescue, that's when you see real panic set in.
As you can see from the video, he also concludes by stating that the market has not been a true reflection of economic realities for a significant period of time due to the reliance on money printing. We can predict that panic will set in among investors when they realize that the Federal Reserve will not intervene to support the market, leading to a potential downturn. It's important to note that this is a summary of Gareth's viewpoint and interpretation of the market conditions. It may not necessarily reflect the overall consensus. What are your opinions on Gareth Soloway's forecast? Share your thoughts in the comments section, and remember to show your support by liking and subscribing. Stay tuned for our upcoming video. Thanks for watching.